Step 5. Preparation of financial statements. So what are the statements which we prepare? Trading account, profit and loss account, balance sheet. So what's the purpose of preparing these statements? So we want to know, did the business earn a profit? What assets does the business own? How much is receivable? How much does the business owe? What is the financial position? Let's take one example. CB Mart at the year end wants to know its profit, cash balance, stock, furniture. How would you able to look at this? All this will appear in the financial statements, right? That's the purpose of preparation of financial statements. Let's discuss one activity. Step versus work. Steps which we discussed: identification, recording, classification, summarization, financial statements. Work done divided into 5 categories. Group similar transactions, show profit and financial position, decide whether an event should be recorded, prepare reports, and the last one, enter transaction in the journal. Now you need to arrange them as per the correct order. But what's the easiest way to do it? Think for a moment. Which step decides whether the event should be recorded? Which step enters transaction in the journal? Which step groups similar transactions together? Which step prepares reports? And finally, which step shows profit and financial position? When you yourself answer these questions, you will definitely going to give the correct answer. Correct answer is identification. Decide whether event should be recorded. Recording. Enter transactions in journal. Classification. Group similar transactions. Summarization. Prepare reports. Financial statements. Show profit and position. Right? Think of this like a relay race. Identification means spotting the runner. Recording means writing their name down. Classification, putting them in the right team. Summarization, showing team scores. Financial statements, announcing the final results. That's the correct order in accounting. Okay, let's now see how the single transaction travels through the accounting process. Let's discuss one example. Suppose CB Mart purchased good worth rupees 1 lakh. Now what are the steps you need to follow? First, this event is identified as a business transaction, right? Next, it is recorded in the journal. Then it is classified into the purchases account in the ledger. After that, it is summarized and included in the trial balance. Finally, it is presented in the financial statements. So here we are showing the journey of our transaction. Purchase, then moves to journal, then moves to ledger, then trial balance, then financial statements, and lastly the decision making. So what's the learning? One transaction passes through multiple stages before appearing in the final accounts. Okay? Common mistakes students make. Thinking transactions go directly into the balance sheet. Believing the journal is the final step. Confusing classification. grouping transactions with summarization, preparing reports, forgetting the correct sequence of steps. Reminder to all of you, every step depends on the previous one. If identification is wrong, recording will be wrong. If recording is wrong, classification will be wrong. And if classification is wrong, the trial balance and financial statements will also be wrong. That's why accuracy at each stage is very critical. Okay, please remember that.